posted a video on Citigroup over a year ago. A lot has happened since then, and as a shareholder myself, I want to know if it's now time to add or hold to the position. If we look at the last 12 months, the stock price has seen a high of $53.23 and a recent low of $39.14. The stock price has been falling since the end of July. If we zoom out and look over 5 years, the trend looks worse. Just prior to the pandemic, it was $80. After the pandemic, May 2021, it eventually hit that level again, before gradually dropping off until where we are here today, which is now just below my average buy price. A quick look at the dividend history. They've been paying dividends since 1986, a major cut after the financial crisis in 2008, then building back up to where we are today. With a price drop, the yield is now over 5%. Let's have a quick look how it's performed against the S&P. If you'd invested $10,000 10 years ago and reinvested the dividends, you would have a total return of 4.91%, ending with a value investment of $10,490.24, a terrible rate of return. The S&P gave a return of $30,654, a 206.47% return. For transparency, I invest in the S&P ETF monthly, as well as individual stocks for diversification, and to ensure all bases are covered. Based on the last 10 years, you wouldn't consider buying Citigroup. From 2011, it's just traded sideways. Looking at the financials, can we find any positives? Citi's market cap is currently $79.8 billion. It's a very low price to sales, which is good. The payout ratio is only 32%, which means the dividend is safe. Revenue has seen no growth, having a steady consistent level of around $75 billion for the last 10 years. EBITDA is back to where it was in 2018, which is the highest it has been since the financial crisis. Free cash flow, although positive, has seen a 65.98% drop in the last year, with net income and EPS having a significant drop as well. Cash to debt is good and they really have it under control. The general trend has been moving up since 2015. They have net $259.73 billion, which is a real big positive. Dividends we've mentioned. Shares outstanding is another positive. They bought back over 1 billion shares since 2014. Considering the payout ratio is only 32%, it's good that they are allocating capital to buy back shares. The return on capital invested has also seen improvements in the last 3 years, which is also good to see. In a recent Barron's article, it says Greenhaven Associates exited its position in Bank of America and bought more Citigroup stock. Greenhaven sold 1.2 million shares in Bank of America and purchased 2.2 million in Citigroup. Edgar Wachenheim III, who is the CEO and chairman of Greenhaven Associates, thinks the stock price could soar to as high as $120. Now, $120 sounds a bit far-fetched. We would have to go back to before 2008 to see that price, but bear in mind before 2008 crash, it was nearly $550. So if Greenhaven Associates analysis is correct, or even partly comes to fruition, then at today's price, this could be seen as a bargain. Wachenheim gives us a breakdown of why he thinks $120 could happen. They estimate $30 to $35 of Citi's profits comes from its payment business, which it calls Treasury and Trade Solutions. This service business generates fee income and deposits. An estimated 5% of earnings could come from security services, also a good investment, also a good business, and another 5 to 10% of earnings comes from investment banking, then a further 10% in wealth management. So that is an estimated 50 to 60% of Citi's profits coming from largely fee-generating business, 20% plus in continuing markets, and then less than 30% of profits come from the riskier competitive banking business. So the business is positioned well for continued profits. Other positives come from the new management of CEO Jane Fraser, taking a hard line of streamlining the business, eliminating unnecessary layers within the company, having the 5 heads of the businesses reporting directly to her. Wachenheim continues that if Citi earns $11 to $12 per share and it sells at 10 times earnings, the profits from owning the shares will be very large. This of course is one point of view, and a very bullish one. Let's see what the other analysts are forecasting. CNN Business have an average 12-month price target of $48, 14.9% upside from where we are today based on 23. TipRanks has an average price target of $50.32, 20.41% upside from where we are today based on 19. And Zacks have an average buy of $51.65, 24.64% upside from where we are today based on 20 analysts. Strong price targets from CNN Business, TipRanks and Zacks. An average between the three of $49.99. If we look at value investing and work out some intrinsic value calculations based on the dividend discounted model, it has a fair price of $44.42, which is 7.2% upside. Then if we have a look at trading multiples, it has a fair price of $63.35, which is 52.9% upside. If we take an average of the analyst expectations and the investing models, that would give us a fair price of $52.58. With a 10% margin of safety, that would give us $47.32, which is higher than where it is now. Even being more cautious at 20% margin, it would give us $42.60, which again is near enough to where we are now at the moment. So this can be seen as a good buying opportunity at these levels in below fair price territory. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.